There's a distinct emotion that washes over you the first time you open your account and see $200,000 staring back at you. It's not pure excitement. It's closer to disbelief blended with a quiet sense of unease. On one side, it's more money than you ever imagined having in your name. On the other, it still feels strangely insufficient. You start calculating in your head and quickly realize you're not even close to retirement, not even close to genuine financial security. And a small voice inside wonders whether you'll ever truly reach that point, or if this is simply the ceiling of what hard work and disciplined saving can achieve. My name is Anderson, and I want to show you something about $200,000 that fundamentally shifts everything once you understand it. Here's what most people assume. Reaching $200,000 is an accomplishment, but it's still early in the wealth building process. And the road from $200,000 to $1 million is essentially the same grind that got you to $200,000 in the first place. Just keep saving, keep working, keep repeating the same habits, and eventually you'll arrive. That's the common belief. But the reality, the truth that separates those who remain stuck at $200,000 from those who turn it into millions, is this. $200,000 is not the starting line. It's the pivot point. It's the stage where the math stops pushing against you and begins pulling in your favor. And if you fail to recognize that shift and adapt your behavior accordingly, you'll squander the most powerful wealth-building years of your life. Let me repeat that. Everything changes at $200,000, but only if you change with it. Think about what it required to reach that number. Most likely you spent close to a decade saving aggressively, living below your means, passing up the lifestyle upgrades your peers were enjoying. Each month felt like a battle. You were constantly pushing against expenses, taxes, and the painfully slow buildup of small increments. Moving from $0 to $50,000 took years. Going from $50,000 to $100,000 happened a bit faster, but it still felt endless. And climbing from $100,000 to $200,000, even with compounding beginning to show itself, still demanded intense consistency and discipline. So you absorb the belief that building wealth is linear, that it will always require the same level of strain, that reaching $1 million simply means repeating the exact process 5 more times. But that's not how mathematics operates, not even remotely. You've just crossed an invisible threshold without realizing it. At $200,000, your capital begins generating more annually than you can reasonably save from your paycheck. Let me explain. If you earn $80,000 per year and save 20%, that's $16,000 annually. That's strong. That's discipline. But $200,000 invested at an average 8% return also produces $16,000 per year without any additional effort from you. Your money is now operating at the same speed as your labor. That's the turning point. That's when compounding stops being a theory you understand intellectually and becomes the primary engine driving your wealth forward. Most people arrive here and never notice. They continue living the same way, saving the same percentage, thinking in the same patterns, and they completely miss the transition. This is where a psychological shift must occur. At $200,000, you have to stop seeing yourself as someone scraping upward from zero and start seeing yourself as someone managing a system. Until now, your net worth grew mainly because of your effort. You worked, you earned, you saved. That was the formula. But beyond $200,000, the majority of your growth comes from what your capital does, not what you personally do. And that demands an entirely different mindset. You're no longer just a disciplined saver. You're a capital allocator. You're deciding where money flows, how it's structured, what level of risk it carries, and what it's designed to achieve. Those decisions begin to matter more than squeezing out a few extra dollars from your paycheck. Let's make this tangible with numbers. Imagine you're 35 years old with $200,000 invested. You continue saving $16,000 per year. If your portfolio earns an average of 8% annually and you consistently add $16,000 each year, here's what unfolds. In year 1, your balance grows to $232,000, $16,000 from your contributions, $16,000 from returns, an even split. By year 5, you're at $314,000. It still feels gradual, still steady. But look at year 10. You reach $508,000. Here's what matters. Of the $308,000 increase from your original $200,000, only $160,000 came from what you saved. The remaining $148,000 came from compounded growth. Your capital is starting to outpace you. By year 15, you're at $821,000. By year 20, you cross $1.3 million. Of the $1.1 million in total growth from that initial $200,000, more than $700,000 came from compounding, not from your deposits. Your money did the majority of the heavy lifting. Your role was simply to stay consistent and let it operate. And this is where your identity shifts. You stop being the person obsessing over every dollar saved and start becoming the person fiercely protecting the compounding engine. Because at this level, the greatest danger is no longer failing to save enough. The real danger is interrupting the compounding process. You withdraw money for a purchase that feels reasonable in the moment. You panic when markets fall and decide to sell, or you grow impatient and divert funds into some new opportunity, promising quicker, flashier returns. Every one of those choices, without exception, disrupts the compounding curve. And breaking that curve at $200,000 is exponentially more expensive than breaking it at $50,000 because the amounts are larger and the time horizon amplifies the damage. Let me walk you through a realistic example. You've built your portfolio to $200,000, and then the market declines by 25%. Suddenly, your balance shows $150,000. That drop feels brutal. It took you years to accumulate that $50,000, and now it's gone in a matter of months. So you react. You sell to stop the discomfort. You move everything into cash and tell yourself you'll re-enter once things feel stable. But the market rebounds faster than you anticipated. By the time you feel confident enough to reinvest, prices have already recovered. You missed the upswing. You locked in the loss. Instead of sitting at $200,000 and continuing the compounding journey towards seven figures, you're back at $150,000, effectively restarting the climb. That single emotional decision costs you years of momentum and potentially hundreds of thousands of dollars in long-term wealth. That's the risk at this stage. The numbers are bigger now, and so are the consequences. Opportunities also begin to look very different at this level. When you have $20,000 invested, a new job that pays $10,000 more per year can feel transformative. It's a 50% increase in income. That's meaningful. But when you already have $200,000 invested, that same $10,000 raise is pleasant, yet hardly life-altering. What truly moves the needle is earning an additional 5% on your portfolio. 5% of $200,000 is $10,000 annually. The same financial impact as the raise, except you didn't have to switch jobs or negotiate harder. You simply allocated capital more effectively. That's the shift. Your greatest financial leverage transitions from optimizing your career to optimizing your investments. Yet most people never adjust their thinking. They remain focused on salary growth while overlooking the fact that portfolio decisions now carry greater weight. Now here's the major mistake many people make once they reach $200,000. They interpret it as permission to elevate their lifestyle. They've been disciplined for years. They delayed gratification. And now that they finally feel some breathing room, they upgrade the car, move into a larger home, book the expensive trip they postponed for years. In their minds, they've earned it. They deserve it. What they fail to calculate is this. Every dollar removed from compounding at $200,000 is a dollar that won't multiply into $4 or $5 by age 55. That $40,000 car purchased in cash, it's not just a $40,000 choice. It's closer to a $160,000 decision when you factor in what that money could have become over 2 decades. The retirees sitting on $3 or $4 million didn't reach that level by celebrating at $200,000. They understood that $200,000 wasn't the finish line, it was the starting signal. There's also a subtle but powerful career shift that occurs when you reach $200,000 and protect it rather than spend it. You stop feeling desperate about your job. You know that if circumstances turn unfavorable, you have a buffer. Not enough to retire comfortably, but enough to create options. Enough to take time searching for the right opportunity instead of accepting the first one available. Enough to negotiate from strength rather than fear. That change in posture, that quiet confidence that comes from having financial flexibility, shows up in every conversation. People sense it, and outcomes begin to shift. You receive stronger offers. You command more respect. You encounter opportunities that wouldn't have appeared when you were operating from urgency. But this advantage only exists if the $200,000 remains intact. If it's been absorbed by lifestyle inflation, you're back to feeling pressured. The strength comes from having the capital and not needing to access it. Here's another warning that derails many people at this stage. They start comparing themselves to those who accumulated wealth faster. They watch someone profit massively from real estate, cryptocurrency, or a startup, and suddenly their steady index fund strategy feels dull and sluggish. So they begin taking unnecessary risks. They move $50,000 into an investment they barely understand because they're chasing a rapid breakthrough. Occasionally it works. More often it doesn't. And when it fails, their compounding base shrinks from $200,000 to $150,000. They lose years of progress attempting to accelerate a process that was already working. The individuals who transformed $200,000 into millions weren't the ones constantly swinging for risky home runs. They were the ones who stayed consistent, who kept contributing, who resisted panic selling, who ignored the temptation of shiny distractions. The people who succeed at this stage are the ones who simply allow math to do what it naturally does when given time and steady input. There's something about opportunity cost at $200,000 that most people never truly grasp. From this point forward, every major purchase doesn't just cost the listed price, it costs the compounded future value of that money. If you spend $60,000 on a boat today, you're not really spending $60,000. You're giving up the $300,000 that $60,000 could have grown into by the time you retire. Maybe that trade-off is worth it. Maybe the experiences, the enjoyment, the memories justify the exchange. But that decision should be made consciously and deliberately, not on impulse. Because most people evaluate purchases based only on the sticker price. They never calculate the long-term cost. And the long-term cost is almost always far greater than they imagine. So here's the core message. Reaching $200,000 is the most critical milestone in your wealth-building journey. Not because it's an enormous sum in absolute terms, but because it marks the turning point where the math shifts. It's where your investments begin to outpace your labor. It's where compounding becomes the dominant force. And what you do in the 5 to 10 years after crossing $200,000 will largely determine whether you end up with a comfortable retirement or something far more substantial, even generational. The climb from $200,000 to $2 million is not 5 times harder than the climb from $0 to $200,000. In reality, it's easier. The figures begin to accelerate. Returns start building on previous returns. Growth stacks upon growth, but only if you don't disrupt the process. Only if you continue contributing. Only if you remain invested during volatility. Only if you resist celebrating with lifestyle expansion. Only if you understand that $200,000 isn't the prize, it's the seed. Right now, you have the opportunity to protect that seed and allow it to grow into something transformative. Not unlimited time, but enough. Enough to commit to leaving it untouched for the next 15 years. Enough to keep adding to it even when progress feels gradual. Enough to tune out the market noise, the comparison traps, the lure of faster wins. Just stay consistent. Let the math operate. Trust that the compounding you can't yet see is quietly working beneath the surface, gathering strength and momentum that will eventually feel unstoppable. And 20 years from now, when you're looking at a portfolio worth millions, when you recognize that your capital worked harder than you ever could, when you realize that choosing to protect $200,000 instead of spending it was the decision that changed everything, you'll remember this moment. The moment you understood that wealth isn't created by working endlessly harder. It's built by allowing compounding to run uninterrupted for as long as possible.